Most people work hard for their money. They trade their precious time for a paycheck. This is what my poor dad taught me. My rich dad taught me something different. He said the rich don't work for money. They make their money work hard for them. This is the fundamental secret to building true wealth. Investing is the pathway to achieve this. It is how you can stop trading your time for dollars. Instead, your dollars start earning more dollars for you, even while you sleep. This shift in mindset is the very first step towards financial freedom and escaping the daily grind. Understanding assets versus liabilities is absolutely crucial. It's a simple concept, yet so many people get it wrong, keeping them financially stuck. An asset is something that puts money into your pocket. Think of a rental property that generates monthly income or stocks that pay dividends. A liability, on the other hand, is something that takes money out of your pocket. This could be a car loan that requires monthly payments, or credit card debt with high interest. The rich focus on acquiring assets. The poor and middle class often acquire liabilities they think are assets. Your goal must be to buy assets that generate income. So, how does a beginner even start this journey? The most important investment you can make is in your financial education. My rich dad always emphasized learning before earning. Read books about money, investing, and business, attend seminars, listen to podcasts, or find a mentor who has achieved the financial success you desire. You don't need to become an expert overnight, but you do need to understand the basic rules of the money game. This knowledge will empower you to make informed decisions. It will also help you spot opportunities that others might miss. Without this education, you are simply gambling, not investing. Before you put a single dollar into any investment, you need to define your financial goals. What are you investing for? Is it for early retirement, a down payment on a house, or to fund your children's education? Clear goals will help you determine your investment strategy. They will dictate your risk tolerance and the types of investments that are suitable for you. Without clear goals, you are like a ship without a rudder, drifting aimlessly. Write down your goals, make them specific and measurable. This clarity will provide direction and motivation on your investment journey. This is a vital step. One common investment vehicle is stocks. When you buy a stock, you are buying a small piece of a company. You become a part owner. If the company does well and its profits grow, the value of your stock may increase. You can then sell your stock for a profit. Some companies also pay dividends, which are a share of their profits distributed to shareholders. Investing in stocks can be very rewarding. However, it also comes with risks. The value of stocks can go down as well as up. Understanding the business you are investing in is key to success in the stock market. Another type of investment is bonds. When you buy a bond, you are essentially lending money to an entity. This entity could be a government or a corporation. In return for your loan, they promise to pay you back the principal amount on a specific date in the future. They also pay you periodic interest payments, known as coupon payments. Bonds are generally considered to be less risky than stocks. They can provide a steady stream of income. However, the returns from bonds are typically lower than potential returns from stocks. They are often used to balance a portfolio. Real estate is another powerful tool for building wealth. My rich dad made a significant portion of his fortune through real estate. You can invest in residential properties like houses or apartments. You can also invest in commercial properties like office buildings or retail spaces. Real estate can generate income through rent, known as cash flow. It can also appreciate in value over time. Leveraging other people's money, like taking a mortgage from a bank, can magnify your returns in real estate. However, real estate requires management and can be illiquid, meaning it's not always easy to sell quickly if you need the cash. Beyond these main categories, there are other investment options. You could invest in your own business or someone else's private business. This can offer very high returns but also comes with significant risk and often requires substantial capital and expertise. Commodities like gold, silver, or oil are another area. Some people invest in these as a hedge against inflation or economic uncertainty. The key is to understand each investment type thoroughly. You must learn about its potential risks and rewards before committing your hard-earned money. Never invest in something you do not understand. That is a recipe for losing money. One of the most important principles for smart investing is diversification. My rich dad often said, Don't put all your eggs in one basket. This means spreading your money across different types of investments. If one investment performs poorly, your other investments can help offset those losses. For example, you might invest in stocks, bonds, and real estate. Within stocks, you might diversify across different industries or different countries. Diversification is a strategy to manage risk. It does not guarantee profits, but it can protect your capital from significant downturns in one specific area. How does diversification truly protect your capital? Different asset classes often behave differently under various economic conditions. For instance, when stocks are down, bonds might be stable or even up. When the local economy is struggling, international investments might be thriving. By holding a mix of assets, you reduce the volatility of your overall portfolio. This makes your investment journey smoother and less stressful. It prevents a single bad investment from wiping out a large portion of your wealth. This careful balance is what sophisticated investors strive for. It is a hallmark of a well-thought-out financial plan. Thorough research and due diligence are non-negotiable. Before you invest in anything, you must do your homework. If you are considering buying stocks, research the company, its financial health, its management team, and its industry. Understand its competitive advantages and potential risks. If you are looking at real estate, investigate the property, the location, market trends, and potential cash flow. Do not rely on hot tips or what everyone else is doing. My rich dad always told me that your profit is made when you buy, not when you sell. This means finding good deals through careful research. Learn from those who have already achieved success. Study the strategies of successful investors like Warren Buffett or others in your chosen field, like real estate. Read their books, interviews, and shareholder letters. Understand their investment philosophy and how they analyze opportunities. You don't need to reinvent the wheel. Success leaves clues. By modeling the habits and strategies of successful investors, you can significantly increase your chances of success. However, remember to adapt their strategies to your own financial situation, goals, and risk tolerance. Blindly copying someone is not the answer. Understanding their principles is. A very common investment pitfall is letting emotions drive your decisions. Fear and greed are powerful forces in the market. When markets are rising, greed can tempt you to invest recklessly, chasing high returns without proper analysis. When markets fall, fear can cause you to panic and sell good investments at a loss. Successful investors learn to control their emotions. They stick to their investment plan and make rational decisions based on facts and research, not on market noise or emotional swings. This emotional discipline is often what separates winners from losers in the investment world. Another frequent mistake is a lack of patience. Many people approach investing like a get-rich-quick scheme. They expect to see huge returns in a short amount of time. Building real wealth through investing is usually a long-term game. It requires patience and discipline. Compound interest, often called the eighth wonder of the world, needs time to work its magic. Chasing quick riches often leads to taking excessive risks or falling for scams. Focus on consistent, steady growth over the long term. Let your assets grow and compound. This requires a long-term perspective. A critical error many beginners make is investing in things they do not understand. If you cannot explain how an investment makes money or what its risks are in simple terms, you should not invest in it. My rich dad always said to invest in what you know or take the time to learn it thoroughly. This applies to complex financial products, new technologies, or even businesses in industries you are unfamiliar with. Investing without understanding is pure speculation, like gambling in a casino. Take the time to educate yourself before you commit your capital. This simple rule can save you from significant losses. The most important step is to start. You can read all the books and attend all the seminars, but nothing happens until you take action. Don't wait for the perfect time to invest, because it rarely comes. Start small if you need to. Even a modest regular investment can grow significantly over time thanks to the power of compounding. Open an investment account. Make your first investment, even if it's just a small amount in a diversified index fund. The key is to begin your journey today, on May 25th, 2025. Learn from your experiences, adjust your strategy as needed, and keep investing for your future. Your financial freedom depends on it.